Great. So we talk about marginal and absorption costing. What you are doing is very simple. The difference between those two is basically how you're going to deal with what you call the fixed manufacturing overheads. So under marginal costing, the fixed manufacturing overheads do not form part of the product costing. And under absorption costing or full costing method, the fixed production overheads forms part of the product cost. Forms part of the product cost. So if you look at that question, that's what I want us to do right away. The following information has been extracted from the books of Delta Limited for the year to 31st of July 2023. So we have the production in units, we have the sales is also given there in units. The production costs incurred are also given there in thousands. That is direct material, direct labor, variable overheads. Then you also have what we call fixed overheads given there. Selling and administration costs are given there also as fixed amounts. Salaries of sales staff, variable sales commission, promotion and advertising expenses, and also have what we call admin costs. Then we are told that the company's unit selling price is 550. That's what we are given. So under required, prepare statement of profit or loss using the following costing techniques. Number one, using marginal costing technique. Number two, using absorption costing technique. So the only thing we need to identify is how to deal with the fixed production costs. With the fixed production costs. Good. So are we together? Are we together? Are we together? August 2023, question number 2B. August 2023, question number 2B. Good. So do we have the question with us? Do we all have the question with us? Great. So what we need to do first is to get the marginal cost and also the absorption cost or full cost. So what is our marginal cost here? Marginal cost. We all know that absorption cost here, it is our marginal cost. It is marginal cost plus fixed production overhead. Plus fixed production overhead. But now our marginal cost, we have direct material, we have direct labor, variable production overhead, and that's all. So when you add the three, when you add the first two, you get what we call prime cost. When you add variable production overhead, you get what we call marginal, you get what we call marginal cost. You get what we call marginal costs. Of course, when you add these ones, you get what we call full cost, full production cost. So let's come here. Direct material. What is the cost of direct material per unit? The cost of direct material per unit. So the examiner has not given us what we call budgeted production. And if you're not given budgeted production, we assume that what is given there is actually budgeted and is also equal to the actual. So when you look at the cost given there, the material cost is 7,200,000. 7,200,000 for how many units? For 30,000 units. So when you take that divided by 30,000, what are you getting as the production or material cost per unit? What is your material cost per unit? What is your material cost per unit? You are getting 240. How are you getting the 240? 7,200,000 divided by 30,000. Divided by 30,000, which represents the units that were produced. Good. How about direct labor? Do the same. 1,800,000 divided by 30,000. That will give us 60. Variable production overheads. Variable production overheads 1,500,000 divided by 30,000. It will give us 50. So when you add all the three, you'll be getting what you call marginal cost. So what's our marginal cost? What is our marginal cost? What is our marginal cost? 350. Good, let's go to this other side. For us to be able to get what we call absorption cost or full cost, we check the marginal cost. I've decided to summarize it because during our discussion, when you are addressing this topic, we did it individually. So under absorption cost, we talked about direct material, direct labor, variable production overhead, right? We are basically bringing in the components of marginal cost. So once we bring in these three items, they are from the marginal cost. They are what are giving us marginal cost. I've decided to condense them and have that figure here. So I hope you understand how we are getting the marginal cost of 350. Then the fixed production overhead. The fixed production overheads, we must be very keen. If we are given budgeted, we must look at the fixed production overhead per unit at what we call at full capacity, So if the company's full capacity production was, let's say, 45,000 units, we could have taken 45,000, or what is given there as the total cost of 2,700,000 divided by the 45,000 units, which is produced at full capacity. But because they have not mentioned that, what are we going to do? We'll assume that the company managed to achieve its full capacity, which in this case happened to be 30,000. So what is the fixed production cost per unit? We take the 2,700,000, we divide by the 30,000 units. So what are you getting? It will give us 90. So when you add the two, what are you getting? When you add the two, what will you have? When you add the two, we'll be having 440. Good. Now, this difference will lead to two items. ATD or CPA? ATD. This difference will lead to what we call, this issue here will lead to two things. Number one, we'll talk about understatement. Understatement of opening stock, if there is any. Number two, it will lead to what we call understatement of closing stock. Understatement of opening stock and also understatement of closing stock. Why the understatement? The understatement will come as a result of this difference. In marginal costing, we are having 350. In absorption costing, we are having 440. The difference actually caused by what? By the fixed production overheads. So our understatement of opening stock will be the opening stock multiplied by the fixed production overhead per unit, right? Fixed production overhead per unit. The understatement of closing stock will be closing stock in terms of quantity multiplied by the fixed production overhead per unit. Fixed production overheads, we have said the fixed production overhead we are given 2,700,000 and we have 30,000 units being produced. We are doing this because the examiner has not given us any different optimal or full capacity. If we had full capacity of 45,000 units, then we could have divided this by 45,000 units, not 30,000. Right? So the 30,000 here, the examiner is silent. That's why we are assuming the company's full capacity point of operation is equivalent to 30,000 units. Is that clear? Is that clear? Good. Now, when you understate opening stock, then your cost of sales will be understated. Understating cost of sales will exaggerate your profit. Understating cost of sales will exaggerate your profit. So how do we get back to the right profit? We deduct the understatement of opening stock. How about closing stock? Remember the components of cost of sales. It is normally opening stock, add production, less closing stock. The closing stock is normally deducted. So when you understate what you are deducting, when you understate closing stock, you will exaggerate cost of sales. And when you exaggerate cost of sales, what will happen? The profits will be understated. How do I get back to the understated profit? I add back the understatement. I add back the understatement. I add back the understatement. Once you get what we have done under these two things, then we are basically doing what we call reconciliation statement without knowing. So you tell us profit as per marginal cost. So profit as per marginal cost, give us the profit as per marginal cost there. Then you less understatement of opening stock, then you add understatement of closing stock. Once you adjust that, whatever you'll be getting will be your profit as per full costing, as per full costing method, which is the absorption costing, right? So profit as per full costing method, which is the absorption costing method. If you prepare something of this kind, we call it reconciliation statement. You are trying to reconcile the cause of difference between net profit as per marginal costing and the profit as per full costing. Good. So are we together up to this point? Are we together? Are we together up to that point before we now finalize the question? Are we together up to that point? Great. So you can now go ahead. We can now go ahead and finalize the question. You can now go ahead and finalize the question. Somebody saying that the board is not clear. Does it apply to everyone? Somebody saying that the board is not clear. Is it the same case to everyone? Is the board clear from your side? It is clear. Yeah, I think it is clear. Thank you. So what I don't want you to forget is the cost per unit under absorption costing, is the cost per unit under marginal costing. So let's start with marginal costing. So let's look at sales. For sales, irrespective, the question is available in the link provided in the group description. I hope all of us have been able to access that. Good. So irrespective of the method you are using, the revenue will not be affected. The revenue will not be affected because you are not interfering with the units that were sold. You are not interfering with the selling price per unit. So let's get our revenue. What's our revenue? What's our revenue? Revenue or sales? Revenue or sales? Revenue or sales. So we are selling how many units? How many units was sold? The company sold 24,000 units and the selling price per unit is 550. The selling price per unit is 550 and quantity sold is 24,000. How much are we talking about here? Linda is giving us 13,200,000. So we have 13,200,000. Then from that, we are using marginal costing. We go to cost of sales. Cost of sales. Our cost of sales under marginal costing will only contain what we call variable production cost. So let's get what we call opening stock. Opening stock. Do we have opening stock? Do you have any opening stock? If yes, we could have been able to bring it using that cost. So we don't have opening stock. How about production? So we add production. We add production. Remember, 30,000 units were produced and the production cost per unit under marginal costing. Tumesema ni ngapi? 350. So can you take 350 multiplied by the 30,000 units that were produced? 350 multiplied by the 30,000 units that were produced. That is 10,500,000. So that will give us 10,500,000. Then to that, remember we need to less closing stock. We need to less closing stock. How many units do we have as the closing stock? What is the quantity of closing stock? Somebody? What is the quantity of closing stock? So opening stock is 0. Add production of 30,000. It gives us goods. So opening stock, add production. Add production. It gives us goods available for sale. So the goods available for sale is equal to 30,000. Only to find out that goods that were sold. Goods that were sold is equal to 24,000. Where did they take the remaining 6,000? You have 30,000 units to sell, but you only managed to sell 24,000. So whatever is remaining will be your closing stock, right? So our closing stock is equal to 6,000. What did we say about the valuation of the closing stock? We value our closing stock at the production cost per unit. At the production cost per unit. So if the examiner was to be a little bit keen, you'll find that they will do a very simple thing. We'll give you opening stock and give you the cost per unit of the opening stock. Then number 2, we give you production during the month. Now, in doing so, we are going to use different cost per unit. Remember, opening stock has got its own cost per unit. What was produced during this particular month has got its own cost per unit. Then we tell you somewhere under additional information that the company is using FIFO method. Or try to complicate things a little bit and tell you the company is using what we call LIFO method. Last in, first out. Last in, first out. What do I mean? When you say last in, first out, then it means whatever was produced during the year will be sold first. So if you add opening stock, these sales will not include the opening stock. So let's say we add opening stock of 4,000, right? And what has been produced is 30,000. We're talking about 34,000. Then what was sold is only 24,000. You are having a closing stock of 10,000. Then we now come and complicate things and tell you, you know what? This opening stock was brought in at 400. Then we tell you what was produced during the year, produced at 350. Right? Then the sales, you sold them, of course, at 500 watts, at 550. Now we complicate these things by just giving one additional information. And what is it? We tell you the company is using what we call LIFO, last in, first out. So when the company is doing so, whatever was produced will be sold first before we sell the opening stock. So for me to get the cost of sales of the 24,000 units that were sold, the entire 24,000 units came from what was produced during the year. So the cost of what was sold is basically 350 times the units that were sold, which is 24,000, right? Now, if you want to get the value of closing stock, this closing stock, remember the company produced 30,000, but they managed to sell 24,000 units. They managed to sell 24,000 units. So our closing stock here, we have 2 of them. We have that one from the opening stock, which has not been sold, the 4,000, which was brought in at 400. Then the other closing stock, we have 10. So the other remaining amount represents 6,000, which was now produced during the year. At what cost? At 350 shillings per unit. So this is how you're going to get the cost of closing stock. That is, if the company was using what we call LIFO, right? So whoever is setting management accounting paper has not decided to subject you to this. Whoever is setting the papers has not decided to actually subject you to this. So what are they doing? Currently, all the questions in the past papers for management accounting and fundamentals of management accounting are currently set or were set under the assumption that the company is using what we call FIFO method, first in, first out. So the 30,000 units that were produced, the 24,000 units that were sold, these 24,000 units entails the opening of 4,000, which will be sold first. Then whatever is remaining represent goods that were produced during the year. That is why when we are going to get the value of our closing stock, we know the quantity is how many units. Our closing stock is 6,000, but we will get the cost of this closing stock as the production cost for the duration. We will not separate it this way. We are assuming that the opening stock will be sold first. So any closing stock will come from what has been produced during the month, right? So that's what currently is being done under that assumption. So somewhere, without mentioning, these questions are using the assumption of what we call FIFO method, valuation of closing stock, which again we did in topic number 4. So here, the production is 10,500. Now, this closing stock we have 6,000, and they have to be valued at the cost or at the production cost per unit. What was our production cost per unit under marginal costing? What was the production cost per unit under marginal costing? Is the first thing under this question. It was 350. So when you take 350 times the quantity of closing stock, what are you getting? When you take 350 times the quantity of our closing stock, that is 2,100,000. 2,100,000. And remember, you're supposed to do what? You're supposed to deduct 2,100,000. And somebody was inquiring, how did we get the 10,500,000? The 10,500,000, you produced 30,000 units. And the production cost under marginal costing is 350 per unit. So 30,000 times 350 should give you 10,500,000. Good. So what are you getting as the production cost? Cost of sales. What is our cost of sales? The cost of sales we are referring to here. The cost of sales, what are we getting? 8,400,000. 8,400,000. Now, when you deduct that from the revenue, what we are getting is called the gross. It's called the gross contribution. It's called the gross contribution. Why are we bringing the word contribution? We are bringing the word contribution because all the expenses that have been mentioned here does not have anything to do with the fixed expense. All of them are variable in nature, and therefore they depend on the number of units. So what is our gross contribution? What is our gross contribution? 4,800,000. We are calling it gross because in our question, we'll be having something called variable non-production expenses, variable sales and distribution, variable admin expenses. So those variable non-production costs has to be deducted from the gross contribution to give us what we call net contribution. So do we have anything in the name of variable non-production expenses? Yes, so under sales and admin costs, the first thing you are able to see there is variable sales commission. So let's look at what we call variable sales commission. Variable sales commission. So how much is the variable sales commission? The figures are given in thousands, that is 300,000. Now what is happening is this. Maybe in your exams, you will not be given variable sales commission as a lump sum figure in that order. No. What if the variable sales commission in your exams is equal to 45 shillings per unit? Will I multiply it by 30,000 or multiply it by 24,000? Somebody to advise me here. Assuming variable sales commission, and we need to take the actual, not budgeted, actual. If it was to be given as 45 per unit, will I multiply it by 24,000 or 30,000? Okay, so some people normally confuse and do it with the units produced. Remember, the sales commission is dependent on the number of units that were sold, and therefore we subject it based on the number of units that were sold. So that will give us 450,000. In this case, we just need to copy and paste it here. Now, when I deduct variable expenses or the variable and production expenses from my gross contribution, whatever you'll be getting is called the net contribution. So we cannot talk about net contribution if that is the only variable expense. So 4 million minus 450,000 inatupatia ngapi? I'm told it is 300,000, not 450. Sorry for that, 300,000. So what are we getting? What is now our net contribution? 4,500,000. Now from this, we can less all the fixed expenses. So less fixed expenses, less fixed expenses. Now, one of the fixed expenses is the fixed production costs. In the marginal costing system, the fixed production cost do not form part of the product cost, but it is expensed in the income statement under expenses. It is written off as a fixed, as an expense in the income statement. So what is the fixed production cost? The fixed production cost, it was it 90 shillings per unit multiplied by the units that were produced? So 90 by 30,000 will give us 2,700,000. So that's what we need to come and record here, 2,700,000. Then we now need to less the fixed and production. And one of the fixed and production is sales or salaries of sales staff. So salaries of sales staff. That is 450,000. Then we have promotion and advertising. Promotion. Advertising. Promotion and advertising. 480,000. Right. Then of course we are having what we call administration costs. Administration cost of 720,000. When you now less all these expenses, what are you getting as the net profit as per marginal costing? What is your net profit as per marginal costing? How did we get 2,700 or 2,700,000? Now, if you look at our table, we are having production, sales, production costing card. Are you able to see the production costing card, Gadoli? The production costing card, we have direct material, direct labor, variable overheads, then the fixed overheads. We have 2 million or 2,700, and the figures are given in thousands. Alternatively, we have fixed cost per unit. Look at the cost, the absorption cost per unit. The absorption cost per unit we are having 440. How did you get the 440? It was the marginal cost plus fixed production overhead per unit, plus fixed production overhead per unit. So 90 times the units that were produced. It also taking me back to 2 million. 700,000. It's taking me back to 2,700,000. So I hope I've answered your question. Great. We are now going to method number 2, that is absorption costing. Absorption costing. So under absorption costing, what do I say? Number 1, irrespective of the method, our sales figure will be the same. Our sales figure will remain constant. That is 13,200,000. 13,200,000. Then let's go to cost of sales. So under cost of sales, remember, under absorption costing, we have been able to include what we call the fixed production overhead to be part of product cost. The moment you bring in fixed production overheads or fixed expenses, we no longer call it contribution margin. We now call it gross profit, net profit, right? Yeah. So under cost of sales, let's bring in the opening stock. Opening stock. Our opening stock here, we have 0 units. And if we could be having the opening stock, we should be having the cost per unit of the opening stock. If that is not given, what do? We use the production cost as the default cost of the opening stock. Marginal cost and absorption cost figures. Okay, that was done during the first part of this class. We did that. It was done during the first part, the first 5 minutes of this class. We were able to do that. So how did we get the 350? Somebody? How did we get the 350 that we are using here? We took direct material, direct labor, and variable production overhead. Under absorption costing, we used direct material, direct labor, variable production overhead, plus fixed production overhead per unit. So that's how we got the 350 and 440. So our opening stock in this case will be 0. We add production. We add production. So production, how many units were produced? 30,000. Production cost per unit under this method, 440. So can you take 30,000 by 440? $30,000 by 440. $30,000 by 440. 30,000 by 440. $13,200,000. Okay, 13,200,000. Then we need to less closing stock. We need to less closing stock. Our closing stock is still 6,000 in units, but now the cost of closing stock will change. It will be 6,000 times 440. So what are we getting? 6,000 by 440? 26,40,000. So that will be 26,40,000. That is what we need to less. So what is our cost of sales? Our cost of sales? $10,560. So we have 10,560,000. When you deduct, you get what we call gross profit. And that gross profit is not just gross. It is adjusted gross profit. Our unadjusted gross profit, itakuwa ngapi? Unadjusted gross profit. That is 2,640,000. 2,640,000. The fixed production overheads have been used as part of the product cost. The 440 we are using here has already included the fixed production overheads. The only thing we want to check Do we have over or under absorption of overheads? That's what we now need to check. So we look at what we call actual stroke budgeted fixed production overheads. What am I trying to say? You must look for actual fixed production overheads. But if you don't find it, use the budgeted fixed production overheads. I'm repeating that. I'm starting with actual or budgeted because in some questions, for example, if you look at CPA, it must be one of the sittings in 2023 or 2024. It must be one of the sittings in 2023 or 2024. We were having what we call actual and budgeted. So students are not able to pick, is it actual or budgeted? Just a minute, please. Good, sorry for that. So if I don't have actual, that's when I will go for budgeted. But if I have the two, I simply go for actual. The actual budgeted fixed production overheads. Do we have that in our question? We don't have actual. So what is given there is the budgeted, and that's what we now take in place of actual fixed production overheads. Good. Then under that, we compare it with what we call fixed or absorbed. Fixed production overheads. The overheads absorbed, again, it is in this class that we talked about what we call overhead absorption rate. So the overhead absorption rate is equal to budgeted overheads divided by what we call budgeted activity level. I'm not being specific because this activity level can be labor hours or machine hours or units produced. We use budgeted or actual. I've said in exams, if you have the two, you go for actual. But if you don't have actual in your exams, under additional information, it's not appearing anywhere. That is when you go for budgeted. That's why I've used the two. It is actual or budgeted. If I have actual, I go for actual. If I have both, I go for actual. If I don't have actual, that's when I go for budgeted in place of actual. Are we together? Are we together? Good. Now, how is this fixed production overheads being absorbed? Is it being absorbed based on the number of units or based on machine hours or labor hours? What is the cost driver for the fixed production overheads? What is the cost driver? What is the activity level for the fixed production overheads? It is the number of units. It is the number of units produced. So can we get our overhead absorption rate? Is budgeted fixed production overheads 2,700,000. We divide by budgeted activity level of 30,000. What is our overhead absorption rate per unit? What is our overhead absorption rate per unit? Were you able to see that figure anywhere when you're getting cost per unit? Were you able to see it anywhere? It was the fixed production cost per unit. The fixed production cost, the budgeted fixed production cost per unit is what we call the overhead absorption rate, the fixed overhead absorption rate. How do we get overheads absorbed? Overheads absorbed is equal to overheads absorption rate of the overheads, general one, times actual activity level. The overheads absorbed is equal to overhead absorption rate times actual activity level. So our overhead absorption rate is already calculated here is equal to 90 times actual activity level. How many units were actually produced? How many units were actually produced? They have not mentioned the budgeted. They have not specified that is the actual units that were produced, right? They have not talked about the budgeted. So if they have not mentioned that, it means our budgeted is equal to actual. Our budgeted is equal to actual. So I'll now take 90 times 30,000. And I want to tell you something that is very simple. Are we all accepting that the 30,000 we are using here is not the same as the 30,000 we used here? Do we all agree? The 30,000 we are using here is not the same as the 30,000 we used here. Do we all agree? Look at the items we are having. In our formula, it is budgeted overheads divided by budgeted activity level or budgeted units. Under absorbed, it is overhead absorption rate times actual activity level, actual units. The first one is budgeted units. The second one is actual units. The reason why we are using 30 in both cases is because our budgeted was 30,000. Our actual is now 30,000. Maybe in your exams, it will not be 30,000 throughout. The budgeted will be 30,000. The actual will be 38,000. Somebody is telling us that this one here has got capital 0. Hey. Good. So I hope you've been able to see what is required here. Budgeted and actual. Those are two different things. Even though the figures are the same as per this question. But what you're supposed to pick when you get to your August exams is budgeted, is actual. And remember, this topic was not tested in April. And it is a major topic in management accounting. So we know what to do with this concept. We know what to do with this concept. Good. So having done that, we have been able to see what are we getting when you multiply? When you multiply, what are you getting? We are getting 2,700,000. 2,700,000. Good. Now, the 2,700,000, you know, come and compare. The real expense is 2,700,000. What was absorbed into the production process is also 2,700,000. We don't have this animal called over or under absorption of overheads, which you are taught in topic number 4. The last part of topic number 4. The real expense is 2,700,000. What was absorbed into the production process is the same as the real expense. We don't have over or under absorption. So we now come here and talk about over stroke under absorption. If we add over absorption, it means the expense that was incurred or absorbed is greater than the real expense. Right? If we are talking about over absorption, then absorbed is greater than actual or budgeted. And what will happen? You overstated the expense. When you overstate the expense, the profit will be reduced. So what do? We add back the over absorption. When you have under absorption, the real expense is 2.7. What was absorbed is 2.4. You have understated your expense. And what happened? It will lead to exaggeration of your profit. How do I get back to the real profit? I deduct the under absorption. Right? So you can talk about add stroke less under absorption. I hope that will make sense to somebody. I hope that will make sense to somebody. And if it is not making sense, please visit the last part of topic number 4. Visit the last part of topic number 4. Visit the last part of topic number 4. So you don't have either of the two, and therefore, so once you do this, these ones are supposed to give you a figure which you bring here. You can see we don't have it. So what do we need to do? We just need to drop it down here and talk about now adjusted gross profit. Adjusted gross profit, this one here, plus or minus what you'll be having here, depending on the answer you have, will give us the same figure, 2640. Good. After doing that, the other items will come, copy and paste. For example, the fixed production overheads have been taken care of, so we don't need to bring it here. Go to fixed product, go to salaries of sales staff, so salaries. So we now come to salaries, or even the variable. We start with the variable sales commission. So variable sales commission, right? It will not be affected because the number of units sold is the same under each method. So the variable sales commission, 300,000. Right? Then we go to salaries of sales staff. Of sales staff. Tuko na ngapi? 450,000. Then we go to promotion and advertising. Promotion and advertising for 80,000. Then we go to administrative costs. Of how much? 720,000. What is your net profit as per absorption costing? What is your net profit as per absorption costing? Your net profit as per absorption costing. Net profit as per absorption costing. Just take this minus all these expenses. Also, this one here, you can help us get it. Net contribution minus all these expenses. Sum total, this one is 690,000. This one is 690,000. 690,000. 690,000. Marginal cost, I'm told, is equal to 150,000. $690, $150. Good. So are we all getting the same figure? Are we all getting the same figure? Are we all getting the same figure as I work on something like here? Are we all getting the same thing? How is this question marked? Final answer or entries? Wow. Uh-huh. So let us come up with the reconciliation statement. Can you try to reconcile the two? Can someone try to reconcile the two? Are you able to reconcile? Are you able to reconcile? Are we able to reconcile? Try reconciling the two. Try reconciling the two. Is there someone who has managed to reconcile? But remember, I gave you the format of reconciliation statement. So is it reconciling? Is your account reconciling? I gave you a reconciliation statement format. I gave you a reconciliation statement format. Just a minute. Good. So which one should I remove? I can go away with this part as we reconcile. Reconciliation statement. Reconciliation. Reconciliation statement. So marginal profit or profit as a marginal costing, it is 150,000. Then what did he say? Less understatement of opening stock, which we are not having. Then add understatement of closing stock. How do you get the understatement? You take overhead absorption rate times closing stock. Our overhead absorption rate, it was 90. We multiply by closing stock, which is 6,000. So what are you getting? 90 by 6,000? 90 by 6,000 is giving us 540. Remember, we are adding. So when you add, what are you getting? 150 plus 540 will give us 690,000. Did you manage to get this 690,000 anywhere under the two methods? Yes, the 690,000 is our net profit as per absorption cost. So net profit as per full costing method. That's how you prepare a reconciliation statement. So let's agree, assuming that you are to take your exams tomorrow and you find this question in your exams, will you be able to get all the 10 marks? Will you be able to get all the 10 marks? Will you be able to get all the 10 marks? Yes, so that's how simple this unit is. That's how simple this unit is. Good, so we've, but you can say closing stock at absorption less closing stock at marginal. You can say closing stock at absorption less closing stock at marginal, get 540. We are talking about understatement of closing stock. The closing stock in absorption costing is equal to 2640. The closing stock in marginal is equal to 21, and the difference between the two represents the understatement. The difference between the two represents the understatement. Is it true that if you get the difference between the value of closing stock as per marginal and the value of closing stock as per absorption costing, you are getting 540,000? Is that the case? Is that what you are getting? And that is what you're actually writing here. That's what you're actually writing here. So if that approach can give you the answer, which of course is giving us good to go, what you need to know is just very simple. How will the understatement of closing stock affect our profit? It will understate our profit, and therefore we add it back. How will understatement of opening stock affect our profit? It will exaggerate our profit. That is why we deduct the understatement. That's why we deduct the understatement. That's why we deduct the understatement. Sijui kama tuko pamoja. Are we together? If you want to do it on your own and understand what is happening, just do this. Have sales. Sema tu sales zako ni 500. Then under cost of sales, we have opening stock, we have production, we have closing stock. So opening stock, weka 100. Production, weka 250. Closing stock, weka 80. Of course, we are deducting. Then it will give you cost of sales, right? So that is 350 minus 80, that will be 270. 270 from 500, that is 230. This is the default. Same in default. That's the default items. So if we want to interfere with the opening stock, we want to understate the opening stock. Our opening stock is 100. If you understate it, let's even take it to 60. So you have decided to remain with the sales of 500. I will interfere in our sales, right? Then opening stock, you are now having 60. Opening stock, we are now having 60, right? Then production is still 250, and the closing stock is still constant. So 60 plus 250, that will be 310. 310 minus 80, that will be 230, right? That will give us 230. Now 230, look at it, it is giving us 270. When you understate opening stock, you are exaggerating your profit from 230 to 270. From 230 to 270. Understatement of opening stock by 40 shillings exaggerates our profit by how much? By 40 shillings. So how do we get back to the real profit? We deduct the understated opening stock. We deduct the understated opening stock. We deduct. What if we were to take the closing stock part? So let's go to the closing stock. We want to interfere with the closing stock. So our sales is not affected this time around in 500. Opening stock is still 100. Production is still 250. Then now closing stock, we want to understate it by 50 or by 30 to 50. So what is the cost of sales? 100 plus 250, that is 350. Minus 50, 300. What will we have here? It will give us 200. Right? When I now understate closing stock from 80 to 50, that is understating it by 30. Look at what's happening to my profit. When I understate closing stock by 30, my profit is understated by 30. My profit reduces from the real one of 230 to 200. How do I rectify the understatement of closing stock? We need to add back the understatement of closing stock so that I get back to the real profit. Right? So that's what we did. We deducted understatement of opening stock. We add back the understatement of closing stock to get back to the real profit. When you do that, we can see here clearly that the accounts are actually reconciling. So are we done with this concept? Are we done with this concept? Good. I know you are preparing and getting ready that if things goes well, you will be an advanced level student come next semester. If things goes well as per your plan, you are actually preparing to be an advanced level students come next semester. Now, these are the things you are going to meet. These are the things you're supposed to understand as early as today, as early as now. So, this topic called cost estimation. And this key method called regression. Right? Now, this regression method, if you are to use it to give us cost function in the form of y is equal to a plus bx, maybe you'll be having x somewhere, you'll be having y somewhere here. Right? So maybe your x is 24, 37, 42, 75. Then this here, 1,200, 1,300, 1,470, 1,526. That is your cost. That is your data, x and y. And you're supposed to give us cost function in this form. Remember, using the regression method, it is summation of what? Summation of y is equal to na plus b summation of x. Then summation of xy is equal to a summation of x plus b summation of x squared. Or b is equal to n summation of x, y minus summation of x summation of y divided by n summation of x squared minus summation of x bracket squared. Then getting the value of a is equal to summation of y minus b summation of x, everything divided by n. So it means you must be having summation of x, summation of y, summation of xy, summation of x squared, and of course you must be having n somewhere. That is what you are required to do at this level. When you now get to advanced management accounting, you'll be given a question of this kind, or you are given a computer output to be able to solve the same thing. In this case, if you use a calculator, what you will be getting from the calculator are these figures. What we get from calculator are these figures. And I'd like to be honest to all of us. If you have not been able to understand how to use calculator from the month of May all the way to 12th of August, yes, I believe there are miracles, but possibly this miracle will not happen between today and when you'll be sitting for your exams next week. Let us be realistic. I do believe in miracles, but if it has not happened from May to 12th of August, the remaining time is too tiny for it to happen until you master the calculator procedure. So what do I advise? Let us stick to one of these two methods, because it is very painful to understand everything about cost estimation, and then you just forget about storing the last digits, and then you miss everything. So painful. But it is very simple to follow this long procedure and have all your marks intact. So after getting your 10 marks, you'll be looking for 40 marks from the other 4 questions. So please let us not risk. If you have not been able to understand the calculator one, let us proceed and use this other approach. Now, this is what I'm trying to explain here, and I want us to do it together. When you now get to advanced level, that is advanced management accounting, this is what you will be subjected to. This is what you will be subjected to. So we have X as 24, we have 37, we have 42, we have 75. Then Y we have 1200, we have 1300, we have 1470, and of course we have 1526. We have 1526. Good. So let me just share my screen with you. Let me just share my screen with you. I hope you'll be able to see it from your side. Good. So are you able to see my screen from your side? Are you able to see my screen from your side? Are you able to see my screen from your side? Good. Now, when you now get to advanced level, we are still going to do the regression, but this is what you are going to meet. You'll be told to go to what we call data analysis, right? Then you locate regression as a function or as a model there. The Y input, so these are the values of Y, including the title, the values of X, including the title. Confirm that the first row has got the title, the confidence level is constant, then the output range. I want the result to be displayed somewhere here. Then you confirm. When you now get to advanced level, the examiner, that is advanced management accounting, which of course currently is compulsory for everyone, right? So at this particular point, this is the value of A, this is the value of B. What you are struggling with now, what you are currently struggling with will actually be done using the computer. And this is the regression we are talking about that we have been discussing. So when you get to advanced management accounting, you now advance to this part. What they will do is very simple. The examiner will simply come and remove one of these items from your workings. For example, the examiner will come and delete this. And then you are told, can you give us the value of this amount? So it is very simple. You take, right? So you take this amount here. You take this amount here. You multiply by this. So it is mean sum of square multiplied by the degree of freedom. You can see we are getting back our remote figure. R square. R square. R square. So R square here will tell us that, you know what? This variable X has got 75% influence on Y. Multiple R, that is now R, the correlation coefficient. X and Y has got a positive or strong positive correlation, has got strong positive correlation. That's what we are going to do. So they give you computer output, then delete this figure. For example, delete this figure here. Then they tell you to get that figure. So what do? You simply come and take the total explained variables, divide by total sum of square, right? You can see it is giving us that removed amount. How do we get multiple R? So once we have our R square, multiple R is equal to the square root, is equal to the square root of R square, is equal to the square root of R square, and you can see what is here. That is what you are going to, that's what you are going to meet when you get to advanced management accounting. Why am I bringing all these stories? Why am I bringing all these stories? And when you get to BDA, the same thing will be done practically. You do the computer output and you interpret the results. And you interpret the results. So now our students have been struggling. Some of those students who don't have the privilege of accessing this have been struggling. These students have been struggling, and how do we solve this issue? How do we solve this issue? How do we solve this issue? Our students have been struggling. The common factor here is very simple. We call it advanced Excel. If you don't have advanced Excel, so look at the problems that are waiting for you. Number one, advanced management accounting will be a disaster. BDA will be a huge problem because in BDA, remember, topic number 3, topic number 2, topic number 3, topic number 4, those are practical areas. To simplify this, 80% in BDA is done in Excel. So imagine getting to BDA and you want to do what? Getting to BDA, you want to learn Excel and then learn the content. It will not be possible. It will not be possible. It will not be possible to manage that paper in one sitting. If you're going to learn Excel, then you now learn the content. So how do you solve this problem? How do you prepare in advance? Join the advanced Excel class so that when you now get to your BDA, you will not be learning these two things at the same time. You will be focusing on the content. Another thing, apart from that, in the real work environment, this is what Excel will do to you. This is what Excel will do to you. You have been struggling. When 𝐬𝐬 updates their portal, when there's anything that has been changed that will be affecting the salary or the payee, you'll have to wait for the calculator. You'll have to wait for this calculator to be actually displayed. Right? Now, how do you manage to do these things without waiting for these calculators to be updated? You are able to come up with your own payroll. Number one, your payroll will include this section where someone has got disability or not, right? You are able to auto-calculate your NSSF, right? You are able to auto-calculate your shift. And imagine, by doing that, you are able to get paid automatically. So for example, if I were to change this figure, for example, to 150,000, let's work with 150,000, right? Look at what it has done. Automatically, I'm able to get the pay. I'm able to get the pay without struggling. Again, if somebody has got a disability, the moment I put yes under disability, then the figure for pay disappears. Why? Because it is less than 150,000. Now, automating these things to simplify your work in terms of making the payroll, some of you here are struggling. Every end month, they have to do these things manually. So if you have 10 or 20 employees, you have to calculate for each and every single employee. At the end of every month, that should not be the case. You should have an automated payroll, right? So that when you key in the figure that this person is supposed to earn, automatically it gives you the net pay. Automatically it does that. Now, it's not about giving you this template. It is about knowing how to come up with this template. It is about knowing how do I put my formulas in Excel. Look at the entire thing. Look at the entire formula. How am I going to do this so that I automate everything in my Excel? That is the power of Excel. With Excel, you can have an automated payroll. You will not struggle with the CSV that you normally upload when you are doing your returns. Be it pay, be it VAT, you'll be able to do that with the Excel knowledge. Now, if you are to request for this training from somewhere else, you should not pay less than 50 or even 30,000 per person. You should not pay less than 50 or 30,000 per person. Now, RCM is doing you a favor and offering this to you. RCM is giving you a favor and giving you this at a discounted price of 3,500. If you have never studied at RCM, or 2,500 if you have ever done any course at RCM. Assuming that everyone in this meeting has done a course at RCM, then of course you are supposed to pay 2,500, right? That is now RCM, then RCM students. Imagine even with this discount, you are again given a deadline of 15th of August. To do what? To now pay 2,500 if you are on RCM. And if you're at RCM, you now pay 1,950 and be able to enjoy this service for any, per short course. You pay 2,500 if it's your first time to join RCM, or pay 1,950. So that, number one, you'll be taught advanced Excel at 1,950. This advanced Excel, number one, will help you to summarize your work to your workplace, will prepare you for advanced management accounting, will prepare you for BBA. And the classes, of course, we know that majority of these students are the ones who are sitting for their CPA exams. You are clearing your exams on Wednesday or Thursday. Then you have all the way to Sunday when the classes will begin. But the offer is ending on 15. So once 15 elapses, we will now go back to 2,500 per student who is at RCM, or 3,500 per student who is studying at RCM for the first time. Right? So apart from preparing you for CPA in your real or day-to-day assignment at your workplace, Excel will do wonders for you. Excel will do wonders. So it is upon you to decide whether to grab this opportunity as early as today or wait until someone overtakes you. How do you take advantage of this offer? You get the pay bill, 62,42,839. Account number, just indicate Excel, right? And of course, it is not only Excel. You want to know how to generate reports in accounting packages. That is Tally, right? That is Sage. That is QuickBooks. Right? Those are accounting packages. Then you now come to Excel. Once you have the Excel knowledge, you are able to now navigate. Of course, we'll also be taught something with iTax. So under iTax, registration of PIN, right? We'll be doing VAT. We'll be doing returns, that is pay, right? We'll be taught NSSF, filing. We'll be taught, currently it is called SHIP, affordable housing levy, right? Then don't forget that we're talking about individual stroke corporate returns. When you join the iTax class, so come next year, you'll be able to file your returns. You'll not need someone to file for your returns. You will have that knowledge and do it yourself. All these, any of these ones here, the discount applies 1,950 for RCM students before or on 15, 2,500 on an RCM students before or on 15. Once that date elapses, we get back to 3,500 for an RCM, 2,500 for RCM per unit. So the information is here with you. What you are going to do with the information now depends on how you have been asking for the Excel knowledge, for the Tally knowledge, for the QuickBooks knowledge. So what you're going to do, you'll be doing the practical in the class, right? You'll be doing the practical in the class. You'll be given assignments. You install these softwares like the QuickBooks, the Tally. You install that, and of course, open your company, enter details, do the sales, and all that. Certificate Definitely, yes. At the end of the training, you get your certificate. At the end of the training, you get your certificate. The videos for all these classes, again, will be recorded as your usual classes. So if in any case you are not able to join even one class due to unavoidable circumstance, again, you get the video for that class so that you catch up before the next class. This has to be done during the holiday. Once you are done with your CPA for the August sitting. So the first Sunday after completing your exams, the training will kick off. The training will kick off. So please take advantage of that. And of course, I've not forgotten my promise. I said someone who was actively participating in what we call RCM 𝗫𝗫𝗄𝗃 will definitely be sponsored for a short course of their choice. You just select one of them here, right? Will all of us in the management accounting class select that person who actually participated actively in RCM 𝗫𝗫𝗄𝗃. That person is entitled to join one of these short courses without paying anything. Without paying anything. That was an agreement, so it has to be fulfilled. That was a promise. Good. So that is what was there. Good. So those who have interest to remain behind, of course, you can join us now for the normal class. Those who still have interest can join us now for the normal class, that is management accounting. Alternatively, you are free to leave. You are free to leave. So I want us to look at something under what we call joint products in management accounting. And of course, anything to do with the service before we end our today's session. So we can just have maybe 8 minutes break. Someone drink some water there, at least you relax before we now join the usual class. Yes, let us start our normal class at 6:10. Let us start our normal class at 6:10.